Hello everyone. We are from Vanguard. My name is Jithin Pradeep. I'm head of AI research and enterprise AI. In my role, I'm responsible for driving foundational AI research in natural language processing, speech, knowledge graph, and important topic for us, AI in finance. And this is Tina, who is an AI ML scientist in my team. Tina, would you like to introduce yourself?
Sure, thanks, Jithin. So my name is Tina Wang. I am a research scientist in the Vanguard Enterprise AI and Research team. So I joined Vanguard in 2021, and before that, I completed my master's degree at the University of Toronto studying machine learning and data science. And really happy to be here.
A brief overview of my team. We are basically enterprise AI and research. In our role, we are exploring various AI research and seeing how we can put that as enterprise product, mostly our custom-made product from ground at Vanguard. Few of the things that we have been working and we have put are, call intelligence platforms at Vanguard, speech transcriptions, redaction technologies, and we have been trying to put our foot in AI in finance domain, exploring reinforcement learning. Today's talk would be mostly around our approach to AI finance in the domain of portfolio construction and dynamic rebalancing. As an agenda of the the talk, we would like to speak about our previous work, which was precursor to the major topic here, objective-driven portfolio construction using reinforcement learning. And how did we reach there? What are the conclusions that we found? Definitely, there is a lot of learnings, and we are continuing on the same path. So at so before I go into the previous work we abbreviated it as ARLIO, which stands for Automated Reinforcement Learning for Investment Optimization. Where do we see this being used at Vanguard? Majorly three different sections. First one is investment management, then robo advising, and other applications. So two main things are investment management and robo advising. Our focus has been on long-term investment horizon. And we see these technologies as assistive tools to help our investment managers to make decisions in terms of portfolio construction and dynamic rebalancing. We wanted this platform to be real-time, end-to-end, and automated. And end-to-end is one of the core things that we wanted to accomplish to the entire problem. As you know, from a classical approach, we can say, first thing is to identify the risk aversion of a client, and then make those decisions in terms of portfolio, consider the market condition, and then make portfolio allocations for the client. But we want to do it end-to-end, use deep learning, and majorly focus on reinforcement learning to do the same. In terms of robo advising, as we know, this consists of the human-machine interaction component as well as investment component. We see ARLIO to be the investment optimization component in this. And the way we see it is, given a client risk profile and the investment goal, ARLIO would be able to postulate various strategies that we could use as a starting point for devising those portfolio allocations. One of the key things that we have seen people play with and very much interested is to explore those simulations where we can use ARLIO to do discovery of new products, or to have these scenarios being made up for market conditions as well as client risk preference that would allow us to generalize some of the portfolio allocation strategies. So as we started this work, this was the first work, and it was done in 2020, ARLIO project. And one thing that the reason we started was definitely there is a big promising world where we wanted to apply AI in the field of asset management, and very particularly to those low frequency asset allocation, which happens, rebalancing investment, which happens on a monthly basis or a quarterly basis, which is core interest to us. One of the problems that two problems that we started seeing at the first when we started this work was the availability of data was very limited when we wanted to model a machine learning models. And then the next one was, I spoke about client risk aversion. And classical method means that, we would go with questionnaires and we get the client risk aversion as an estimate. We felt, and it's just personal view here from the team perspective too, but we felt that it's a bit more imaginary when we are going through questionnaire and there are bias that can get introduced because of which. So we wanted to come up with a method where we can use estimate the risk aversion of a client based on the previous historical portfolio holdings that the client had. As I speak now, like 2 years back, I would have thought, and it's a great thing, let's do it. But as I speak now, I know, in the very statement lies the contradiction, because, I'm assuming my client knows the risk, and that's why their portfolio would, good, can give me a good, view of what the risk is, what their investment goal is. And that was the outcome of this study. So in order to do this, I don't want to take much time on this. So in order to do this, we had two components. One was the online investment inverse optimization task, which would give us the risk profile of the client. And we used the questionnaires along with it to have a more guided approach to that. And then the next was the reinforcement learning component that would create the portfolio. But we were not able to achieve end-to-end. And that's where the next work comes into play. For ARLIO, we did some evaluation, and this is the results on out of sample data from April 2016 to October 2020. And during this, one of the things that you could see is we are selecting the stocks ourselves, creating those portfolio. For this experiment, that was an assumption that we made. And we wanted to, that's why I was emphasizing on the end-to-end factor, because in the next method, we wanted to do those selection also using reinforcement learning approaches. This is the entire long only monthly performance for ARLIO. And I'll hand it over to Tina to actually take over the objective driven portfolio construction on reinforcement learning, and what are the things that we discovered here.
Thank you, Jithin, for the great introduction of our previous work. So so from here on, I'll introduce objective-driven portfolio construction using reinforcement learning, which is a recent paper that we published. It was related to our previous work and also inspired from it, but it is a standalone research and exploring a new direction of applying reinforcement learning in portfolio optimization. So portfolio construction has been a long existing problem in finance. It is really complicated and hard to be formulated because there are millions of impacting factors that might or might not be identified, which leads to that it is almost impossible to predict the stock market accurately and then make the portfolio allocation choices accordingly. And also, a lot of times we see that investors, they don't have a single standard for a good portfolio, so they have different financial needs. Some of them, they're looking for high returns, and some of them, they're looking for lower risk, and other people might care about the trading frequency. For example, like how active is my strategy? So based on those challenges, we formulate our problem to be a portfolio optimization problem with the investment universe of the entire stock pool that excludes derivatives and funds. And we put the investment horizon from 1971 to 2016. So it is a pretty long period. So we want to capture all kinds of economic environments. And also the rebalancing frequency of our portfolio is set to be monthly because we would like to capture more of those long-term trends rather than short-term noises in the stock market. And in terms of the objective functions, we'll discuss that later. And the investment strategy is set to be long only, which means no short selling is allowed in this case. And finally, the information space, we use 55 numerical features, which we'll also discuss more details later. So after formulating our problem, we are clear that our main goal of this project is to build a model that could automatically construct a portfolio that suits different financial needs of investors. So this portfolio should automatically pick stocks and rebalance itself on a monthly basis. And the resulting portfolio should be able to have the flexibility to support different financial needs and risk preferences of different investors. So according to all those goals, we decide to extend the architecture, deep reinforcement learning architecture that is proposed in this reference paper. So a brief introduction on the mechanism of deep reinforcement learning. So reinforcement learning is one of the paradigm in machine learning, but unlike supervised learning, it doesn't need the data to have labels. Rather, it learns through interactions with the environment and a reward signal. So for example, in this case, the model is called an agent, and then it interacts with the environment and observe the current information, which called state. So after observing this state, our model will take an action. And according to that action, it will receive a reward signal that it uses to adjust itself. For example, if the reward it receives is good, then the same type of action will be encouraged in the future similar situation. And vice versa, if the reward is bad, then the same type of action will be discouraged in this future similar situation. So putting our problem into the language of deep reinforcement learning, the state, which is the currently available information, are the 55 numerical features of all the I stocks in our pool for the past 12 months. So we use a look back window of past 12 months to include some historical information. And also the action in this case is a vector of dimension I, where each entry of this vector represents the allocation proportion of that stock at that time point. And the rewards principle is the monthly return of the portfolio. So as we mentioned, a good portfolio doesn't have a single standard. So now I'll introduce the main contribution of our paper, which are the different optimization objective formulations that to support different financial objectives and risk preferences. So the fundamental objective function is Sharpe ratio. It takes into account of return and volatility as the risk measure. And it is directly used as the maximization objective because we want to maximize the risk-adjusted return. And then furthermore, we developed 3 other objective functions that people care about. The first one is information ratio. So information ratio is similar to Sharpe ratio, that it is also a measure of risk-adjusted return. However, Sharpe ratio uses notional return, while information ratio uses some premium return benchmarked on some index. So here we use S&P 500 as the benchmark. And people are more interested in information ratio because it directly measures the performance of the portfolio manager. It measures, indicates the access return for the portfolio strategy over directly buying some index in the market. So we are also using information ratio directly as the maximization optimization because it is similar to Sharpe ratio. And the second objective that we found interesting is called maximum drawdown. So it measures the biggest percentage loss from a peak to a trough that occurs after that peak. So people care about maximum drawdown because of liquidity limitations. So people often see maximum drawdown as the level of riskiness rather than the simple volatility. So as we want to put maximum drawdown into this optimization problem, we actually developed this linear combination between Sharpe ratio and maximum drawdown, where there's a hyperparameter alpha that controls the level of focus on Sharpe ratio, so that investors could actually adjust this hyperparameter alpha and find a portfolio that they are most comfortable with. And thirdly, turnover rate. So turnover rate measures how big the portfolio allocation changes at each rebalancing time. It is a direct measure of the transaction cost and how active the strategy is. And similarly, as we want to incorporate turnover rate in our objective, we also developed that linear combination between Sharpe ratio and turnover rate. Now I'll briefly introduce the model architecture, deep learning architecture that is proposed in the reference paper. There are three main components of this deep learning model. The first one is called sequence representation extraction module. It is a transformer encoder that extracts the latent embedding of each stock separately from the historical trajectory. However, the independent analysis of each stock is not enough in the stock market because we know that stocks are usually interdependent. So the second component of this model is called cross-asset attention network. So it is also an attention network that computes the cross correlation between stocks, and it generates a scalar winner score for each stock at the end. And the third component is portfolio generator. It is simply taking the winner score from the last step and pick the top 10% of the stock with the highest winner score, and then apply a softmax function to get the asset allocation weight. So remember, we said the output action is a vector of dimension I, where they sum up to 1. It corresponds to the portfolio allocation. So this softmax function actually achieves that goal. And next, briefly touch on the data and features that we use. So all the data we use are publicly available from the WRDS database. And as I mentioned, we use the time span from 1971 to 2016, which corresponds to 1.8 million records in total and 14,000 unique stocks. And this table below are some samples of the features that we use. They could be categorized into stock-related features, for example, monthly return, momentum, short-term reversal, valuation-related, profitability-related, and leverage and liquidity-related variables. So with all the details that I mentioned earlier, let's move on to the result part. So in this slide, I showed the result for the Sharpe ratio experiment and the information ratio experiment. So on the left, the graph plots the accumulative wealth of the Sharpe ratio experiment for all the testing period, starting from a wealth of 1. You can see that our portfolio generates an annualized return of over 21.6% of return and annualized volatility of 18.6% on average, which results in a Sharpe ratio of 1.2 and a maximum drawdown of negative 33%. So as we can see on the graph, it achieves a really high accumulative wealth at the end of the testing period because of the really high annualized return. So by maximizing Sharpe ratio, we can obtain a strategy that reach a really high return, but also bear some risks. And on the right, we show the similar result for the information ratio case, where the information ratio is calculated benchmarked on the S&P 500 returns. And we can see that it achieves an annualized return of 16.3%, annualized volatility of 13.7%, and also a similar Sharpe ratio of 1.18 and a similar maximum drawdown. So in this case, by maximizing information ratio, we can compare that the orange line is the S&P 500 index. We can see that we definitely outperform our benchmark by a lot, by a big margin, and it actually achieves a relatively smoother curve with a lower annualized return and the lower volatility comparing with the Sharpe ratio case. And this slide shows the result for the maximum drawdown and turnover rate. So as we mentioned earlier, in the objective function for maximum drawdown and turnover, there's actually a hyperparameter weight that like alpha, it could adjust the degree of focus on Sharpe ratio or on maximum drawdown. So we actually conducted a lot of experiments with different hyperparameter alphas and generates different strategies based on that risk preferences. So we actually allow investors to adjust their risk preferences and input different hyperparameters, and they can actually generate different portfolios that they are most comfortable with. And all the points on the curve are different experiments that we conducted, and there is a clear relationship between annualized return and absolute maximum drawdown that with a bigger focus on Sharpe ratio, we can achieve a portfolio that is more profitable, reaching higher return, but also bears more risk with a much bigger drawdown in this case. So this actually aligns with our intuition that with a higher return, we get more risk. And it also aligns with a theoretical result that is proven by other people's study that uses pure mathematical programming. They also plotted that this same concave shape efficient frontier. And also on the right, we did kind of the same series of experiments for turnover rate that we found that as we have a strategy with higher turnover rate, which means that our strategy is more active, then we can get a more profitable portfolio with a higher return. So this also aligns with our intuition.
Tina, if I can add, for the return to turnover part, we don't have a theoretical alignment. The theoretical alignment work was with respect to efficient frontier curves on return to maximum drawdown, but we thought it would be great for us to extend it and see what happens on the turnover side as well. So we see an efficient frontier curve for that, but at the same time, we don't have something backing at the theoretical side where mathematical programming has been used. But for maximum drawdown, we can see that curves fits almost smoothly.
So the next thing we did is trying to use some basic machine learning model to interpret our black box deep learning model. So we actually developed this random forest model regressed on the winner score that is output by our deep learning model and use the feature importance metric to explain this random forest and also extend it to the original deep learning model. And also we want to distinguish between the top performing stocks and the bottom performing stocks. So we actually split the data set into top and bottom set, where the top set are the stocks that are likely to be included in our portfolio, and bottom set is said to be stocks that are unlikely to be included or likely to be excluded in our portfolio, to see what are the different factors that a model is using to include stocks and exclude stocks. So the table on the right is actually the different set of factors that we found important in the random forest model. And we found that for the top performing set, like features like total assets, turnover rate, spread, or idiosyncratic volatilities are really important. And for the bottom performing set, like company level financial attributes are more important, like return, market capitalization, and some ratios are more important for the model to exclude that company from the portfolio. So, and also before drawing to the final conclusion, just want to show another interesting experiment that we did, which is to change the number of stock to trade at each time point. So in this experiment, we actually use a more recent timeline of 1993 to 2020. And also we limit the stock universe to be S&P 500 constituents only. So in this case, we can do a direct comparison from our strategy with the benchmark S&P 500 index. And this, so in this experiment, we changed its hyperparameter G, where G stands for how many stocks that we can allocate a positive proportion at each time point. So G equals 5 means that out of the 500 stocks, we can only assign 5 stocks with a positive allocation, and all other stocks are assigned a weight of 0. So it is really interesting that we see that with the experiment of G equals 5, G equals 20, G equals 50, and 100 respectively, we actually observe that when we increase the number of stocks to trade at each point, the return actually decreases. So this is actually an interesting finding that we see a trade-off between diversification and profitability. And it also indicates that even with the more recent time period, with a shorter training period, and with a more limited large cap company choices, our model can still outperform the benchmark S&P 500. So some key takeaways from our project is, by conducting this whole series of different experiments, we definitely see a great potential of applying reinforcement learning in the problem of portfolio construction that could support different financial needs of investors. So with the flexibility and adaptability of our model, I think this model could support the need of not only different financial objective functions, but also maybe in different financial markets, not limited to stock markets. And also we see that in all the experiments that we showed previously, we definitely see that the model could reach a balance between achieving high returns and controlling risks. And in terms of future directions, we are expecting to apply more stable or more advanced reinforcement learning algorithms to further do some research in this field. Maybe Jithin, you can add more.
Yeah, I would say, like, from stock selection, which was one of the things that we wanted to accompany, we did, like, were able to demonstrate it. But where are we with it? Are we confident about it? The last experiment that Tina showed, where varying value of G, it almost felt like we are reaching to that limit with the portfolio. So we want to explore it a bit more, because from a diversification standpoint, you have less number of stocks. It's not diversifying as well as you would want to. So we definitely want to explore that. The next thing that we want to do is, in the last set of experiments, you could see that we have reduced the time period to 1993 and onward. The reason was we wanted to introduce NLP features into the network, and we are targeting SEC filings to start with, and news followed by that. So SEC filings got only digitalized after 1991, and we could only get the data from 1993. That was the reason to reduce that. So that's an area we are actively investing to understand how we can incorporate NLP based features. Yeah, I think these are the directions that we wanted to take forward. And one key things that we are able to establish with this is like the objective functions, which are trying to mimic various kind of strategies that somebody would want. And coming back to what I said previously about the last work, we don't want to assume, given your portfolio allocation, your risk would be this. So we wanted to come back to a strategy where we can say, okay, can you combine all those into a controllable formation rather than having them as individual objective functions? So that's our next step, where we could combine them into a mathematical equation where we could say, we can control them after the model is being built. Right now, we would have to create different models for all these objectives to come up with all that strategy. So it's almost independent of each other. And we definitely know that those are not independent factors. those are requirement for any investor when they come to. So those are the few directions that we wanted to